Friends, happy evening to all of you. I welcome you all to this day 3 of refresher course on accounting standards. Today we have CA Vinod Balachandran, who is going to cover the important accounting standards, being the AS 4, 7, 9 and 12, of which I feel the AS 9, the revenue recognition, and AS 4, contingencies and events occurring after the balance sheet, are the most important ones, where a lot of doubts comes as to, a call should be taken this way or that way. Many a time it is the professional judgment which helps, but nevertheless we should not miss out on what is there in the standard and take some other decision out of it. So two important standards out of the 4 which will get covered today. So I welcome you, CA Vinodji. And also joining with us is our treasurer of SIRC of ICAI, CA Geeta Madam. Before I request Abhishek to introduce and ask the speaker to speak, I will request CA Geeta Ma'am to share her thoughts before we take things forward. Geeta Ma'am, over to you.
Yeah. Hello.
You're audible, ma'am.
Audible. Okay. Dynamic chairman of SIRC, CA DC Jain sir, and our youngest secretary, Dr. CA Abhishek Murali, and our speaker of today's program, CA Vinod Balachandran, and all the members who are virtually present here. Happy evening to all of you. The accounting standards itself is a crux of presentation of financial statements, and let me be precise. Knowledge of accounting standards of what distinguishes the financials prepared by CAs, then financials prepared by other graduates. So no wonder if with the IFRS and with the emergence of IndAS, updation has to be done at a core level to enhance our adaptability to the international standards to render quality of services to our clients with respect to compliances. So it takes almost half of the time to learn when someone who is well versed briefs us on the same, and it is again half of the time when whatever is being briefed is refreshed or brushed up effectively in less time. So this refresher course is a boon to refresh our takeaways on the accounting standards. I hope all of us are going to have a wonderful journey ahead, and wishing you a best learning experience. Thank you.
Thank you. Thank you so much, Geeta ma'am, for a very lovely welcome address. Chairman, shall I proceed with introducing the speaker?
Yes, Abhishek. We can please go ahead, Abhishek.
Great. So a very good evening to all the viewers who have joined in today. The dynamic chairman, Sri Dungachan Jain, he is in fact leading from the front. I must say all preparations for our regional conference is going full swing, and the chairman, despite a very hectic schedule, I must add, we're trying to make it as engaging as possible. This virtual regional conference for the first time we are holding, and it's very hectic, but chairman has, despite the hectic schedule, he said he will come and he will give the welcome address. So I thank chairman for joining us despite this busy schedule. We also have with us CA Geeta, our treasurer, and a very resourceful treasurer, I might add. She gave a very lovely welcome address, and it's always a joy to share the dais with ma'am. She's doing a phenomenal job this year as a treasurer, and if accounting standards have to be complied with at our ICAI level, she is doing a phenomenal job in ensuring by doing her weekly reviews of the the accounting statements and how the financials are. So thank you, Geeta ma'am, for joining us again today. And of course, our speaker for the day, CA Vinod Balachandran, who I now have the pleasure of introducing. He is a FCA, ACIS, a chartered secretary from London, insolvency professional, a management development program from IIM Bangalore he has completed, IFRS in ACCA. He has got the certification, and he's also done his DISA from ICAI. He is a product of Billy Moria, or rather now known as Deloitte, and he is a special invitee of the Accounting Standards Board of ICAI. His professional career is littered with a lot of glittering stars. He is a financial controller of Indian Hotels, that is from the Tata Group, for almost 10 years, and he was based out of Mumbai. He was the head of finance, of property development and hospitality of the Al Fardan Group in Qatar for 6 years. He was the CFO of an NRI based group in India for 2 years, and now he's practicing as an insolvency professional as well. He has more than 2 decades of industry and corporate finance experience, and since 2013 he has been in practice. So this is only a brief introduction. He's based out of Kerala and he's a wonderful speaker. Thank you so much, Vinod sir, for accepting our invitation to be here with our audience today. We welcome you, sir. We're looking forward to your session.
Thank you, sir. Thank you. Shall we commence the session? Okay. Hello, I hope you are able to hear me clearly. We will.
Yes, sir, you are audible, sir. You are audible.
Okay.
Go ahead, sir.
Okay. I'll just put on the share screen and come. Can you put the share screen so that I can get the PPT?
Selva, if you can just give the right, Selva.
No, it's
Yeah,
already
no,
shared, sir. You can
it's
just
already
okay,
there.
yeah, it's
Yeah,
already
I'm-
You
shared.
can click share screen and get going.
Yeah.
Yes.
I just,
Visible now, sir.
is
Visible now.
visible now? Okay.
Yes, we can see.
Just give me a minute.
So we'll turn off our video so that the speaker will be having.
Yeah. Okay. Yeah. Good evening. Today we will have interesting discussion on 4 accounting standards. Accounting standard 4 is basically relating to the COVID impact this year, so it's very important. And following the accounting standard can give us some relief during this time. There are some very interesting developments and clarifications given by ICAI on reporting during COVID times. Then we have revenue recognition standard, which is very important. And in the Financial Review and Reporting Board of ICAI, we have found many errors which are cropping up in the accounting standards because of lack of awareness or due to some minor error while following these standards. So what we are going to do is that we are going to start with the revenue recognition standard first, AS9, and from there we will take the things forward. The rest of the standards are pretty small, and this is a standard which might need a bit of refreshing. There's nothing which you do not know, very simple. We will focus on generally some of the common mistakes which are happening in these standards. Instead of me speaking all the time during the session, if anybody would like to speak, please inform your name. We'll open up the mic. Or those who have any questions also, you can just prompt me, or you can just put in questions and we will take it on the way. So that's how we are going to do it. Every 5-10 minutes, maybe we can take up any questions if there are. So based on that, I think we will quickly begin. This revenue recognition standard AS9, one of the most common issues what we are facing is it only covers sale of goods, services, interest, royalties, and dividend. Now, if you have profit on sale of assets, foreign exchange fluctuation, all those other kinds of income, that doesn't come under the standard. So one of the common things what we see is when people write the notes to accounts under revenue income recognition or revenue recognition, profit on sale is mentioned. So many things are mentioned. So that is one of the first thing we need to understand is that this standard only covers these 5 items: sale of goods, sale of service, interest, royalty, and dividend. All other things don't come under AS9. It cannot be called revenue. So in your P&L account, normally we should show it as other income and give some clarification. It is not operating income, or it is not part of the main revenue of the business, unless you are in that line of business. That's starting what we need to do. This slide, if you can have the time to read through, is the most important. And as I told you, this is where the maximum mistakes are happening in the audited accounts. Realized gains, revaluation, unrealized forex gains or realized forex gains, restatements, all these things we generally call it revenue. Now that is not revenue, and those are excluded from AS 9. So when you write the notes, etc., please keep in mind that if you have income other than what is mentioned in the standard, it is not part of revenue. You treat it as other income and you give explanation separately. This we already discussed what is revenue. Principally, what needs to be understood is that when can you raise an invoice for sale of goods? Primary condition, risk and reward should transfer. Along with risk and reward, under Transfer of Property Act also, the transfer also should happen. Generally, in most cases, both happen simultaneously. But in today's age of online delivery systems, etc., there could be a lot of gaps where we have to be careful as to has the transfer really happened, or is the delivery blocked at some point of time under Transfer of Property Act because of a particular request from buyer or seller. Sometimes, you know, there will be some conditions that only if you do like this, then only I will do like this. So primarily, that is what needs to be kept in mind. The risk and reward, or what we call it, effective control, passes to buyer. Now, when you are moving to the Ind AS environment, it is a control principle for revenue recognition. Control has to transfer, not risk and reward. Buyer should be in control of the asset or the item. Here, we don't talk about control, we talk about effective control. That is risk and reward. So sometimes during the time when you actually deal, you will come across some situations whereby even though risk and reward is transferred, there is some blocks. We will look at few examples a bit later. So to recognize sale of goods revenue, risk and reward should transfer. The amount of billing should be clear, no confusion on the price, and collection should be confirmed, reasonably confirmed. If you feel that there is no chance of collection, you cannot. For example, you sold to North Korea. You don't know whether that person will pay from North Korea, nor can you go and collect it from there. So technically, I don't think you can show revenue. An example.
Sir, 1 minute, sir. Selva here.
Yep. Yep.
Have we moved the slides so we can't see the slides? It's in the first page itself.
You can't see?
Yeah, I can see, sir. I can see the slide, but it's in the first page itself. Can you just stop share a screen again, share it, please?
Oh, one second. Let me just go into that. Sorry. Let me just go into that.
You can.
Not... Yeah. Now I think it should have come.
Yeah.
Now
it is.
Now is there?
Yes.
Yes, yes.
Okay, thank you. Just audience, sorry, I think the slide did not move. Anyway, you did not miss anything great. So
yes.
This slide is actually a good thing. It started on this slide. This is the only important slide where many times, you know, there is a confusion. Seller transfers goods to the buyer for a consideration. That we all know. Now, the transfer of goods in most cases results in transfer of risk and reward and ownership to the buyer in most cases. However, there may be situations where transfer of property in the goods does not coincide with risk and reward. Both will be moving at two different times. For example, INCOTERMS, you know, you will have CIF value, FOB value, some other value. So many times I transferred risk to you, but really the transfers have not happened under the Act, because sale of goods under Transfer of Property Act. So that transfer of property many times does not happen. So we see in many of the accounts some confusion arising here, because blindly we'll go into risk and reward, because for us risk and reward transfer is the primary condition. There's no other condition. While if you are in Ind AS environment, control should transfer. We are not bothered about risk and reward. Control. If I control the goods, I get it. So this paragraph, why I put it is that revenue in such situations is recognized at the time of transfer of significant risk and reward to the buyer. Such cases may arise where delivery has been delayed through the fault of either the buyer or the seller. For example, you go to a shop, you buy a television, and they have given you the billing also. from Spencer's in Chennai, you buy a television and they gave the invoice. Then you tell the counter clerk, sorry, my office is not ready, so I cannot take the television with me now. I will take it after 2 weeks, but I'm ready to pay and accept all the risk and reward. So under the accounting standard concept, sale has happened. Sale bill is raised and you can account AS9 sale. Because risk and reward is transferred, the block has come from the buyer because of some difficulty he is having. From seller's perspective, everything is gone. But if you're in India's environment, again, you are done the billing and the customer says, sorry, my office is not ready. I'll take it after 1 week. Then you have a problem. In such a situation, since control has not moved to the buyer due to the request of the buyer, from the sale price, imagine the television sale price is maybe 100 rupees. For the 1 week you are parking the TV in your godown or something, you should allocate a bit of rental cost also. So the TV sale price could be maybe 95 and 5 rupees could be rental income. So the India moves in very peculiar direction. While in AS9 is more easier, if risk and reward transfers, and you have to look at it in a holistic way, look at the INCOTERMS also, if it is FOB, CIF, etc., because that would have some bearing on when it's exactly transferring. Because there are cases like you are in a transformer business, you are making large transformers, and transformers business include making the transformer, transporting it in a lorry to your destination and installing it. So there is production and installation. Many times what happens, the company takes care of the transportation. So customer has not seen it until the transformer is released from the factory and comes to the customer's premise and he installs it. There is no sale. But in many accounts, you will see that people book the sale of transformer when it moves out of the factory. They say that one sale is over, only the installation is pending. Now, what they forget is that the seller is transferring the transformer in his own lorry. So again, if the lorry, imagine the lorry meets with an accident, the risk and reward has not moved to the seller because it is CIF value he has negotiated, cost, insurance, and freight. So until the CIF finish, risk and reward has not transferred. So you got to be very careful here. AS9 is extremely sensitive and you have to have a good grip on the INCOTERMS, which are mentioned part of the contract, to know when the sale happens. There could be delays in some cases. We will take some of the examples. So shipping terms, right of return, repurchase, installation, inspection. If all these things are in the sales contract, you have to ensure that these are complete to book the sales, or you should book the sale on piecemeal. If it is, allocate the performance obligation, they call it. So this is something very remarkable in sale of goods. If you are principal versus agent, only the commission should be booked as sales. The agent should not show gross income and gross expense. Only his commission should be income. Collection and payment should be in the balance sheet. So there is also many times fraud happens this way. They just inflate the income and expenses, commission agents. So you have to be careful. AS9 clearly says if you are commission agent, only the commission you book. Excise duty, you are already aware. In AS9, we show gross and net of excise duty. So this is nothing new. In the Ind AS, when you move to the Ind AS, this has been done away with. There is no concept of grossing up excise duty, etc., etc. Now, sale of goods. So you account based on risk and reward. Very clear. And what about sale of service? When sale of service comes, slight difference. It's a percentage completion method largely. You work out milestones like software. You work out milestone or like auditing service when the service is complete. Unless there is a contract which says every 20%, if I finish, you will pay me this much. So proportionate completion is largely used in AS9. You may also use the completed contract method if it is a single act. So you will choose between completed contracts and percentage completion. Now, when you move to the Ind AS environment, there is a confusion here because Ind AS largely moves on completed contract method. Now, there are 3 clear exceptions in Ind AS wherein you are allowed to use percentage completion. Other than that, largely it is a completed contract method. So when you switch between companies, AS to Ind AS, you have to be careful. AS gives both options. Ind AS is largely completed, but you may use percentage completion if you have 3 specific objects are there. So this is also nothing new which you don't know. This is just a summary of, percentage completion and completed contract method. You can just read through if you have time. Nothing great in this. It just tells you. Largely, if you look at real estate companies and all that, we all do percentage completion method. Here also same thing, collection uncertainty is a major factor. You should, if you are billing service, you must ensure that there is a reasonable chance of collecting the money. If you're just billing for the heck of billing, it's not an income. So completed contract means revenue is recognized when it's complete. Otherwise, percentage means on slab basis or, based on certain this one. The third aspect of AS9 is other income. So you have sale of goods, sale of service, and only 3 other income: interest, royalty, and dividend. That's what I told in the beginning. Like profit on sale of asset, realized gain, forex, this, that doesn't come under AS9. So when you write the notes, don't put all that under revenue recognition because it's not a revenue. Now in this, the big change, what has happened, dividend declaration, you would already know. When Ind AS came to India, Ind AS abolished the concept of proposed dividend. There's no concept that, you show proposed dividend, go back to previous year and change the entries. Now, there is no such concept. As and when the dividend is declared and approved in the AGM, only on that day you will account for the income. So there is a big change. This change already AS has done few years back. I'm just recollecting your memory. So you will have interest income, royalty income, and dividend income. So this is something very basic, nothing new for all of you. Those of you who are from Ind AS background, the interest income under Ind AS is accounted in a very different way. There's effective interest rate method. So leave that out. Here it is largely similar. It just goes to 26 AS and you can just pick it up. So this is the concept. What we are going to, so the 3 main concept of AS9 we explained. We are going to look at a lot of practical examples where this is where a lot of light comes into the standard. First one, delivery is delayed at buyer's request, but buyer accepts the billing. Like I told you the TV example. So here you have to recognize revenue because buyer said, I will take delivery later. Condition in this, the item must be identified and ready for delivery. If the item is still under production, you cannot book sale invoice. So that's the only thing you have to keep in mind. Again, just to remind, during the session, if you want to speak or you have queries, put it in questions, or you can just tell us you want to speak. So we can try and take up your queries. Okay.
So there is option to raise a hand 1 minute. So that those who raise hand, we can unmute them. So they can self-mute themselves. Whenever needed, they can unmute and speak to us.
Correct. So audience, please, those who would like to speak also most welcome. Otherwise, very boring for me to speak like this. Now, the second part of revenue recognition is installation and inspection. There are many times sale of goods happen where you need installation, inspections. You have to wait for it to happen. Sometimes revenues on approval. You also would have dealt with consignment sales. Only when the goods are sold to third party. Cash on delivery. Today's age, with COVID, you have all delivery systems running, online delivery systems where they say collect from customer. So revenue should be recognized only when cash is received by his seller. Okay, you ordered some food from a shopping mall and the guy brings it in the bike. Until you pay that, there is no revenue. So that is something you have to keep. Many companies don't bother about it. They just take billing as revenue. It's not. If it's cash on delivery, after you get the cash, that's a condition. So you have to just keep that in mind. Trade discounts, you understand that better, it's deducted. But again, you have to understand from GST perspective, many companies, especially wholesalers or manufacturers, after the sale happens, they will send credit notes. Now, those credit notes won't have any tax or GST, nothing. So these are called financial credit notes without GST. Now, financial credit note without GST are treated as income. So that comes under the AS 9. So there is a lot of confusion there. A lot of people reduce it from purchase cost. Some people show it as sales. So post-sale discounts are income. You can show it as sales, and you can write appropriate notes in the accounts. This is the list of generally errors we find in the balance sheet or P&L on application of AS 9. This is based on various audit reports, submitted in India. This gives us a very clear thinking line on where the issues are. First issue, when accrual base of income is not followed. Many people write dividend is accounted on receipt basis. You will see in the notes many times. In the accounting policy there, dividend is accounted on cash basis. Now that is an issue because technically that is not the solution. Dividend should be accounted when the AGM approves it in the annual general meeting, when the right to receive is accrued. Okay. Second one, advertisement revenue. Many people recognize advertisement revenue only when they get the money, like all these agencies, advertisement agencies, etc. Once you make payment, then only there is the invoice. That's wrong. When the advertisement appears in the newspaper, service is done. They have to book the sales. So in many of these kinds of industries in advertising and television, you will see a lot of gaps. They defer the sales recognition till money is received, which is actually wrong. So if you're auditor or you're working in those companies, that timing difference is something you have to watch out so that you don't fall foul of AS 9. Sale of tickets. You sell tickets for IPL and all that in advance. In many companies, we observe that immediately it is accounted as sale. Now, which is wrong. That sale will happen only when the event happens. So if the cricket match is after 1 month, till 1 month, you should show it as advance received, pay GST on it. And on the date of the match or event, the function, on that day only you have to book. So that is AS 9. And to audience, I hope you are able to follow my train of thought. So if you can just put something in chat or comments, I know that I'm able to relate to what you're all thinking. So if somebody has time, just put something in chat. Okay, it's very clear. Thank you, Prernaji. Thank you. So at least I get to know that I'm going in a particular method. Please keep on putting all your things in the Q&A sections so that it's helped me in correcting myself. Then software. Many people account software sales on a percentage completion basis. And when you actually go for audit or when you actually ask them for information, they don't have any, they just say 20% is finished, so 20% is revenue. That's wrong. There should be completion certificate, milestones, signed by customer and both people. Like Infosys is doing, Infosys as well as the customer both would have signed off, saying that, okay, 20% is finished. Only then you can recognize. In many companies, we see from the mind, they just put a figure, this much is complete. Educational services. Now, you have Byju's app and so many educational services coming online. It's very interesting if you look at their billing. How do they bill? If you really think about it, you take 1 year tuitions from an app, 10,000, 12,000 rupees. So there are two options. Either book 1,000 every month, proportionate, or the correct way is you have to look at the educational content and allocate the revenue for content. Now that is where a lot of people are not able to do it. Many people just take divide by 2 or divide by 4 and just, if it is 12,000 every quarter, 3,000 rupees, finish. Now they don't relate that income to the classes being taken. Now this is where the mistake is in AS 9. So if you're auditing these kinds of services, or if you are CFO or you are a finance manager in those companies, you have to alert them saying that you're going against AS9. It is not time proportionate basis. It is number of classes or content basis. So if you're an online or some education system, if you're offering 100 classes, you have to allocate cost to each class and split the revenue based on classes taken. So classes are not taken, no revenue. So very, very important. This is a very big error we see in many balance sheets in AS9. Insurance claim. People put as yeah, during the year. One second, I just got a query. Just give me a second. I'm not able to read it. Sometimes it happens that there's a query I'm just reading. Sometimes it's happened that when we order any product online, money is refunded, but the product is not returned by the buyer. So it is treated as trade discount by vendor, or what are the? Yes, this is a very good question. It is a loss. If you are not, they give you a refund, but the goods are with you. So as far as they are concerned, goods have gone. The e-commerce company is not bothered. The reason being, the goods don't belong to them. They are just a platform. So the seller of the goods takes the loss. It is this loss in production, damaged goods or something like that. And he loses input tax GST on those items. So it's a good question you have told, especially in this online world. Refund is not linked with return of goods. Many people don't return because the cost of returning is more than the refund. So they just say, keep it with you. So this is a very, very good question. Thank you. I couldn't get the name in the chat, so I'm not telling. Then insurance claim is only if the claim is sanctioned. Just because you file an insurance claim does not mean you can book revenue as other income. The insurance company should have sanctioned the amount. That paper should be there. Okay, approved. Not collection, approval. So this gap we have seen in many accounts. Because if the fire has happened to damage the losses, they just put insurance claim. Even though the claim is only being discussed. Claim is finalized and they're saying you will get the claim, but nothing in writing. So unless the insurance company approves a claim, you cannot show revenue, because when they show expense, we show income. That's how it works. Interim and final dividend. As I told you, final dividend, no longer the proposed dividend concept is there. Dividend is accounted. We will take it in the AS4 when we are dealing with it. Interim dividend, you can recognize, because that is interim. Another confusion a lot of people have is subsidiary giving significant dividend to holding company. When to account? Many times, you know, there is no revenue, so subsidiary is made to show huge profits and declare huge dividends. When will holding company declare it? That is when the board of director declares. Dividend is accounted when the board of director declares, as far as subsidiary and holding company is concerned. No need to wait for AGM. For regular different, AGM has to approve. Subsidiary holding company, since both are one, if board of directors approve, you can assume that the AGM has approved it and you can account for the income. So this is a very interesting thing. Those who are having subsidiary and holding, you can use this option and account income earlier, before the AGM. Now, this is a very interesting question. Sale of good, time of recognition. To pay basis, you know, many courier companies in export and all that, there's a lot of things. To pay option is there. Only if you pay, revenue is recognized. So when to pay come, what happens? Again, in every account, there is a lot of different treatment. So ICAI as export advisory committee, they have put the suggestion that effective control of the goods reach the hands of the buyer. Effective control. So you are exporting 10 crore worth of equipment to a person in Bombay, Chennai to Bombay, transferring or selling. So it comes in a big ship, 10 crores. And it is subject to submission of all documents, then the sale is complete. So 10 crore goods came to port, it is taken out in huge machine and reaches the factory. And out of the documentation, 1 or 2 documentation is pending. So just because some documentation is pending doesn't mean that you cannot show revenue. Because you should look at inherent concept. So effective control is transferred, 1 or 2 few documentation, something is pending, don't bother about it. So for big shipments, it is not really based on payment, the to pay concern, but smaller couriers, when courier companies work 1,000 rupees, 3,000 rupees packages, only to pay. But it's a 10 crore package, you will realize that it is not really the payment which is the sale. So you have to look at it in a very different manner. Again, like our person asked the question, today's online world due to COVID, sales are accounted on dispatch of product. In notes to accounts, we have seen this line. I will only account sale when I dispatch. So which is a very no, it is completely against AS 9. So you should not write this in notes that my accounting policy is only on dispatch. Dividend from foreign country. Now, as I told you, North Korea, etc. You are getting dividend from North Korea or some war-torn country where there is a serious problem, or there is a country which is broke. They don't have foreign exchange. So just because there the AGM is held and dividend is declared, doesn't mean you should account for it. Then you have to look at FEMA rules, etc., whether you'll really get it, because collection uncertainty. So only when the uncertainty is removed and really the transfer are in place, you should book the income. Profit on sale of investment, show it as exceptional activity in the accounts. So there is nothing to do with this. So I'm just telling you. Again, we have seen this note, sale through e-commerce. Sale is recognized only on receipt of money. So in that, some of the suggestions is that commission or sale only when goods are delivered. Sale of goods act, property will be transferred in case of CIF basis. So cost, insurance, freight. You have to look at it. As I told you, CIF means cost plus insurance plus freight. So when does the property risk actually transfers? You have to be careful. So INCOTERMS are a major thing in this AS9. Waiver of liability. Many times, your liability is waived off, so you get an income. So many people treat it as a revenue recognition under AS9. It is not. A reduction in liability is not an AS9. This is an interesting example we have found out. In real estate or many deals, it is like that. You pay an initial advance, and after some years, if the customer rejects it, it's like, sale and reject, sale on approval, you can call it. I will sell you, use it for 2-3 years. If you don't like it, give it back. But if you like it, there is a price to pay. Especially in shopping malls, etc. You can see in clothes item, etc. You take the shirt. After, they will say you can return it after 6 months also. So many people return after using. But then at that time, there will be a rate difference. It's like this. This example says 10 per square feet. After 5 years, if you do not return it back, 15 per square feet, I will buy back or something like that. If it is rejected. So I'm selling it to you at 10 and I'll buy back from you at 15. Many times these deals are struck to push sales, saying that if you don't like, after 2 years, I'll buy back. So whenever these buyback clauses are there, you have to ensure that the difference is treated as interest cost. Many times it's not accounted only. So from starting itself, you should understand that if the price differential because of time is an interest. Promotional offers like gaming sites and all, you will see today lots of ads coming, joins various sites. They'll give you so much of free from beginning. The 1,000 rupees free, it is in your wallet immediately. So that is not an income. It should be treated as advertisement expenditure. Okay. So these are some of the issues we find in many audited accounts on lack of understanding of AS9. This is a question. I would like you to read the question and the answer and just tell me whether it makes any sense to you. It's a simple thing. What happens to interest on sundry debtors? To increase my income, can I just say so many people have not paid in time, so I'm going to charge interest income? Is that allowed under AS 9? Please go through it slowly. Take your time and go through it. The company has never before collected interest on delayed receivables. But now COVID and all those things, they suddenly decide that I want to charge interest on delayed debtors. Many companies are doing it. Is that income? Can you recognize? So the answer says you cannot, because there was no prior practice of charging income and there is no uncertainty that your customers will pay you the income. So in such cases, suddenly if you decide I will charge some extra charges, income like the banks do, suddenly they charge you overriding charge or some other charge. So you got to be careful there under AS 9. This is an example of consignment basis. I have sold goods of 1,50,000. 20% was unsold. So how much will you recognize under AS 9? Consignment basis means only if you sell, it is a sale. So 80% of 1,50,000 we can recognize as a sale. This is again consignment. Many times you don't get any approval or disapproval from the buyer. This is a sale on approval basis, like a consignment sale. You have sold, no official notification. What do? So if it's a sale on approval basis, if it's for a specialized equipment or some particular type of food or something, unless you get an approval, you cannot book the sale. So that is something to be kept in mind. This is an INCOTERMS chart I have put. Most of you know INCOTERMS, but if you want to understand AS9, you have to understand these INCOTERMS to know when a risk and reward transfers to you. It shows, from seller takes it in a truck to the port. In the port, it is loaded to the ship. This is called FOB. If your FOB terms means your risk and reward transfers here. Then the ship reaches this cargo, cost insurance freight. If the freight is either up to the port or freight is up to the godown. So a chart like this will help you analyze when a risk and reward is transferring, so that under AS9 you can book the income. So you should know most of these INCOTERMS, like most popular is FOB and CIF, etc. So very, very important for you to keep in mind, so that you know the timing of the transfer of risk and reward. There are some new changes in INCOTERMS. There are some new terminology now. Delivered at terminal is replaced to delivered at place unloaded, DAPU, DPU. You will find now many purchase order, export bills and all saying DPU. So delivered at place unloaded, it is called. The new terms. Free carrier, there is a new thing which has come. Buyer can instruct its carrier to issue a bill of lading with a notation to the seller. This is regard for letter of credit. This again, lots and lots new selling concepts coming into the market with the type of trade and environment changing, COVID, etc., online business increasing. When the risk and reward transfer is a classic question. So all of you need to keep in mind that it is extremely critical to understand the INCOTERMS and find out when are you responsible for that product, even though delivery has not reached. Because the delivery control is in the Ind AS. In AS, it is risk and reward. Technically, delivery and risk and reward go together, but just to tell you, many times it need not. So it depends upon the terms and conditions. Things will change. Disclosures, there is nothing major. Along in the same lines of AS9 is the other AS, same AS, which is for construction contracts. So we will take both together so that, you know, then we can have any discussions if required. So we have AS9, which is dealing with sale of goods, services, interest and dividend, etc. And you have AS7, which deals with construction contracts. Now, if you're outside India, before, you know, traditionally it is construction is viewed in two ways. If you're buying a flat, just like that, as is where is basis, it is treated as sale of goods. But if you're buying a flat where you go and change the design, the color, and you are involved in the construction, and as a customer, it is being made to your specification, then it is AS level. So it is called managerial involvement. You are involved. So sale of goods in service in construction, sale of goods means completed contract method. Only when it is finished you account income. While if you are involved in that, it is proportionate consolidation. That was the concept outside for a long time. In India, we have, as we discussed before, proportionate and completed contract basis. So we'll have a look at this. Anyway, any queries, anything? Because I don't see anything moving. Can you just put in chat? Up to now, are we clear? Okay, I've got some questions. I'm just trying to read.
So 1 minute, sir. The questions pane, if you see the arrow mark over there, it will expand as a big
That's
window.
what I'm trying to pick the question. Just 1 second. Yeah, first slide. 1 second. I saw one question now. Where the other questions?
No, so you can see the question mark on the bottom of the right below the orange arrow mark. You can see the last one, the question mark, right? If you click on that, it will open an external window.
Just a second. I'm just trying to figure it out where it is.
No, orange arrow mark where you can see external window, right? Right below the last one would be the question mark, where you can see the questions pane.
Here, this one.
Yes, click on that one. It will open the external window.
This one.
Not that one, so that I can see.
1 second. Just give me a 1 minute, audience. I'm just trying to figure out how to get the questions.
No, the thing is, you can see external window, right? So the orange arrow mark below that audio, video options, everything, right?
On top, this one.
Yes. Right below, you can see the last one. It shares a small chat message kind of a thing where you can see question mark over there.
I'm sorry, I'm not able to figure out.
Okay, if that is the case, you just see the questions panel where you can see into mark, right? Next to that, you can see the small arrow mark kind of a thing, right? You click on that one, it will open the external window.
I'm sorry, I'm not able to get it clear. Is it possible you can just read out? I'm not able to.
Yes, I can read out, so no problem. This question around 544 says that in this case, when returns after 3 years with different rate, how it will be recognized in seller's book when it was sold?
Oh, that is one question. Okay, this is regarding the 3 years return. That is,
yes.
Understand. So that means I'm taking up a question because I'm not able to see the questions clearly here. So what is happening is that if I sell you something for 10 rupees and after 3 years, you're saying, okay, I don't want those, or you know, something. So I'm ready to buy it back at maybe 12 rupees. Maybe it's a real estate land. It is appreciated. So I sold it to you at 10 and I'm taking back 12. That means that differential is an interest cost or an interest income. It should not be treated as two different sales. That is what we want to make it clear. Okay, next question.
As of now, they said there is up to now, it's very clear. The last one is, can we revisit the INCOTERMS again? Mr. Prasad.
Yeah. Okay. INCOTERMS I'm coming to, because that I could see a bit clearly. Just 1 second. I'm coming to the INCOTERMS. INCOTERMS is the most critical thing which all of us need to understand. And there is tremendous confusion across. Sir, this is the INCOTERMS side. Basically, if you just stare at it for some time, It is just telling from supplier's warehouse, which is the first this black thing, and on the right side this ending is our customer's office. So from supplier to customer or seller to buyer, the goods are moving. So when you do contracts, you should read through contracts where they write who is responsible to pay what. Maybe the loading charges, unloading charges, shipping bill, customs clearing charges, insurance. So many costs will be there when cargo is being moved from one place to another. Then there will be regulation like GST, e-way bill you have to take. So many things. So INCOTERMS basically is telling us how and when risk and reward will transfer, because AS9 clearly says risk and reward. So how do you know sitting in your office has risk and reward transferred? Goods are still in the truck. Take another example, high sea sale. I am exporting goods from here to Europe. In the middle of the sea, the buyer's ship is crossing my path, and the buyer says, okay, give it to me. I will take it from here. So in the middle of the sea, you exchange. So buyer has got control. While your contract says CF value, I am responsible right up to the end. This is happening in many cases. There are insurance issues and there's many issues. So sometimes halfway when the goods are being sold, things will change. So what you need to do? You have to make sure there is sufficient documentation or documentation changes are happening, or get the customer to accept the delivery with the condition that now he is responsible. So here the most popular, easy to understand is cost insurance freight. Means the seller is responsible to bring the goods right up to your godown. Only then sale happens. Up to the time, if the goods are destroyed, fire happens, accident, you have nothing to do with it. So that is why sometimes you should tell your customer, if they want to book sale early, the truck invoice or the transportation, the customer should pay for it. So then what happens? The customer is already in control. So this is INCOTERMS. There are many INCOTERMS as and when, based on your type of business, you will be putting the terms FCA, FAS, FDS, CFH, CNF, DAP, DCP, so many. So this chart is actually helpful. You can just Google it, all kinds of charts you can get. I hope that was clear. Sir, any other question was there?
That's it, sir. That's it, sir. And also, you can see your WhatsApp message I sent you how to open the question screen.
I will just
so that will be easy for you to just look at.
Yeah, no problem. Okay, I'll just try. Audience, just a minute. I'm just trying to figure out how to view your questions.
You can see the video.
Yeah, I got it. Oh, it's the one on the top. Sorry. Okay.
Yes,
sorry.
yes.
Now I'm learning this. So thank you, boss. That's very easy.
Yeah, and you can again close it, again reopen it whenever it needed. You can close that one.
Okay. Excellent. So we had 4 questions from Balasubramaniam, Premnath, Ramnathan, and Rajalakshmi. So I hope the comments. So I hope all of you are satisfied in your comments. Anything else, please tell me. I've learned how to access this question blank. Now we will just do a bit of construction contract so that we do income and expense both together. So in construction, instead of doing just talking to you, I would like to take you to a whiteboard. So I'm just stop sharing the screen. Sir, I will try that. Sharing stop, I'm going to do.
So you can stop share a screen and you can just straight away go to the board. Yeah.
Now I think sharing is stopped.
It's not stopped, sir. You need to click again. The green color should go off. Now it's gone off. Now it's gone off. You can turn to the board.
Just tell me, are you able to see this board clearly?
Yes, I can, sir. Please.
Audience also, you're able to see the board clearly, I hope. Please put some comments if you are able to see, so I know that you're listening also. Yes, 1 or 2 audience, whoever is listening, can you put some chat that you are able to see?
They mentioned it, so you can see it in.
Okay, I'm not. Okay.
Open that one.
Yeah, construction contracts. I'll just do it on the board. It's more easier that way. And anyway, these are things which you know, nothing what you don't know. very interesting things. Also, we'll give you comparative AS Ind AS where you will see where there's a lot of fundamental things changing in this construction contracts. So just give me a minute. I will just a second. Okay. Now, this is a building. Okay. I hope this is clear. Now, if this building, what the ICAI guidance note says on real estate, ICAI says that if this is and if this is the 25% completion line, if the construction is complete more than 25%, and for 20% if there are customers, and out of these customers, if 10% has paid money, some advance, or 10% is received as money, then you can start proportionate consolidation. This ICAI guidance note says. So 25, 25, 10, 3 quantitative guidelines. If you don't meet that threshold, CWIP, work in progress, you cannot do AS7. So this is simple ICAI guidelines. CWIP is no, this is AS7, 25/10 principle. So this you already know. So even though the building is not complete under real estate accounting in India, if you cross the threshold, you have to recognize if the contract is for 100 rupees and 25% is complete, you have to show 25 rupees income. If the construction cost is 50 rupees only, then 25% of 50. 12 rupees 50, you will show expense. So you have a profit of 12.5. So you have to pay income tax even before the building is completed or sold. This is called proportionate consolidation. So I hope that is clear. Now, what are the changes? When you move to the Ind AS environment, a very big change happens. So you should know both, because you could be handling both. In Ind AS environment, what happens? Outside India, if you are outside India, that is foreign country, land and building is treated as a new concept called investment property. And investment property has to be fair valued, not cost. Here we do cost base. So I'll tell you example how things got misused in Dubai or in other countries because of IFRS or Ind AS, and why ICAI does not allow it in the AS environment or in India. So very important, you have to know. So if construction of land and building has to be done fair value or something like that, AS7 says proportionate consolidation and the 25/25/10 rule. So imagine this building is or 30% complete outside India. This building has to be accounted in the balance sheet using fair value. That means you have to value the building as if it is completely complete. Nothing has happened. The building is just half done or quarter done. So you will appoint valuers, and the valuers will come and tell if the building is complete, then we can rent it out for maybe 1,000 rupees. And maybe 10 to 20 multiples of 1,000, maybe 10,000 is the fair value of the building. That is, tomorrow if you want to sell the building, this is a fair value price. So at 10,000, you have to now book the P&L. So what happens if it's your profit and loss account? You have to P&L should reflect the fair value. So what happens? Maybe your cost is only 7,000 actually what you constructed. The valuer has given price of 10,000. So a 3,000, this is profit and loss account. So 3,000 straight goes to income without doing anything. Building is not complete. Nothing has happened. Suddenly you have a huge income, 3,000 rupees. You know, in big contract, it will be 3 million or 300 million or whatever. So when it goes to P&L, what happens? They declare dividend, take the money and run away. Building is not complete. So this is one of the gaps in IFRS, that this can be misused, the fair valuation. So when the IFRS was brought into India in the form of Ind AS, the ICAI being very wise, they said nothing doing, only at cost you can do all the construction. So land and building construction will be at cost. So that stopped that problem. But then there was a bigger issue. The revenue recognition standard is called Ind AS 115. Ind AS 115 largely works on completed contract method. So in 2018, 1st April 2018, when Ind AS 115 was introduced in India, many real estate companies which were doing proportionate consolidation, proportionate method of this one, contract method, when Ind AS came, they were confused. Can we move into completed contract method? That means for a large real estate project, you will no longer do the 25-25-10 approach. You wait for the building to complete, and only when it is sold, you pay the income tax, or it's all completed contract method. So there was abject chaos in India. First quarter of Q1 2018, everybody were confused what to do, the real estate companies. Then, as usual, ICAI has bought a guidance note, educational material on 115, and they have clearly clarified that Ind AS or IFRS gives 3 exceptions from doing completed contract method. That means proportional construction method or billing method, percentage completion method, or we call it percentage completion method, can be used if 3 conditions are satisfied. 1, as and when you construct, the buyer should take delivery of it. Now that doesn't happen in real estate. A half finished room, I cannot go and stay in that. So this option is gone, because Ind AS gives, if I am constructing and you are taking handover immediately, proportionate consolidation or percentage completion is allowed. Second, you are the customer and you have a piece of land in Chennai. This land is yours, and you are telling the builder, construct a building inside this land for me. So it's inside your area. You are in control. Then percentage completion is allowed. The third one was the master clarification by ICAI for real estate flats. You know, you buy apartments. All the apartments look same. So Ind AS has given a clarification that the third point is, if a construction is specifically done for you, then you can do percentage completion method. So ICAI has given clarification saying that if I'm buying a flat and in that building there are 1,000 flats, or maybe there are 10 flats in that building. There are 10 flats and all flats are same. So I'm not doing anything specific to go and change the interior design, nothing, and change the structure, foundation, etc. So it's not anything special. So how to use that point number 3? So ICAI has given clarification saying that the Transfer of Property Act in India, you know, where you buy and sell buildings, register the buildings in the property department, registration department. The laws in India needs to be checked, because each state has got a unique law for land, for that state subject. So if I default on an EMI, can the builder give my flat to another person? That's the question you have to ask. So as long as you cannot, and under Indian law, now you have RERA Act and IBPI, insolvency, etc. The builder cannot just because I didn't pay 2 installments, cannot remove me and give it to somebody else. They're strictly not allowed. So that means I'm still in control. So under the relevant laws, if the builder cannot do it, it is percentage completion method. So ICAI has solved the issue under Ind AS. So real estate companies can also do percentage completion method of accounting. So this is these clarifications, whether it is under Ind AS or not under Ind AS, don't bother about it. But very, very important to know that whichever, either you are in the AS environment or you are in the Ind AS environment, you have to be very careful. The risk and reward concept, whether you can do percentage completion method or completed contract method. Very, very important for you to understand. And generally the ICAI guidance note is there, the 25-25-10 formula for AS7. And that is largely to be used. Now I will just take up the other queries which I'm able to see now. From Rajalakshmi, still on the AS9. Do we still need to disclose accounting policy of dividend when I'm not getting to declare dividend during the year? Yes, you must. You must write. Dividend will be accounted based on if the dividend is approved and you have a right to receive. And if you have not received, you put a note, they have not declared dividend. It's better that way. Instead of writing nothing, because if you have an investment in some company, people will expect. Now, Arati's question, sometimes it happens that when we order any product online, if you are not satisfied with the product, money is refunded, but the product is not. This we took the question before, but
yes, you can scroll down to see the last one. So you can scroll down to see the time. Yes.
Okay, that Arati, I think we'll take care of your question. Yeah,
so
that also
we have not received any query post that, sir. We can continue.
Okay. Sorry, I'm just learning this thing. So
yeah, no problem, sir.
Okay, thank you. So any queries, you can put it up. So we will quickly go through. We can't view the presentation. Now, can you view?
Yes, it's view. We can view now, sir. No, that is resolved, sir. That is resolved. We can continue. Now we can.
Thomas, I think we got it. Yes. Now, so construction contracts, we just explained the concept. You have two things: percentage completion, completed contract. Accounting standard Ind AS, we have taken care of that. Some theoretical concepts, fixed price contract, these are things these are not important for our things. Now, what are contract costs? This is where again we find a lot of mistakes, because imagine I have only one building, then all the cost I incur I put in CWIP until the 25% limit is reached. Now that is wrong. Administration and general cost, general manager cost, audit fees, these kinds of costs, you should always take it to P&L account. You cannot put in CWIP. So AS11 does not tell you that put everything under CWIP. So this is a common error we are finding everywhere, that people conveniently capitalize most of these expenses, saying that a building is in construction, so there is no cost. So if you are having a corporate head office or those kinds of situations, my suggestion is that please take it all to P&L account. Don't capitalize. The important thing to recognize here is that in many times in real estate, percentage completion, etc., there is no clarity as to revenue, because it is still being discussed. If you're dealing with government, they will say initial order estimate approved 10 crores. Now there is a variation order in process. The site engineer has said, it's a hard bottom, so I have to dig more and more cost I have to take, etc., etc. So you will submit variation orders. Now there's a temptation to immediately book the variation as an income. But again, like dividend, etc., you got to wait until it is in writing and approved. You cannot take variation orders or extra orders. You got to wait. And preferably, If you feel that your cost of the building is maybe 20 rupees and you will exceed the cost to 22, 23, you know from beginning. So you have to make sure that the loss is fully provided for. You can't wait for the building to complete and then book the loss. On a percentage completion basis, the loss also should be booked. So this is again an issue we are facing. Many people don't exactly, this timing difference is not really taken care. So as an example, please try to read through. It just explains a few concepts of AS 7, construction contracts. Have a look. I think this is very clear for you, 50 and 53, the difference. So 3 crore is exceeded, so you would really have to immediately book this loss. Now, this is a different question. Please go through. You could just maybe write in piece of paper so that the answer is in the next slide. So I'll show that. Just anybody in the chat also could try to do this. I will take question from Vidyut ji in that time. Try to do that question to see whether you can get that answer. If a Vidyut's question, if a bank loan is taken specifically for a project, can the interest on that loan be capitalized? Also, salaries, etc., for the project manager and directly project related member, can they not be capitalized? A good question. Interest, specific interest can be capitalized. Even general borrowing, you can apportion to this project. So our AS on borrowing clearly tells you how to apportion it. Even general borrowing cost, if you can allocate that out of 100 crores of bank overdraft, 10 crore was used for building construction. 10% of that interest cost can be capitalized. So specific cost, you can do it. Now, as regards salary apportionment, for those who are directly connected with the project, site engineer, project engineer, 100% you must capitalize. But then if you're in large companies and if you feel that cost is very immaterial, you may just charge it off. But largely, if they are only doing that project and they're not connected with any admin work, like making budget, this, that, and all, then you should capitalize Vidyut ji. Okay, Krishnan and Dinesh has given some answers. Let's just wait for others also if they can just try to do this. So this is the answer. Have a look at it. Slightly different from what you all felt. How it should be booked. Concept is same. 15 crore, there is a cost overrun. So that is clear. How to book that 15 crore in a percentage completion basis? What it says, moment you know your project is overrun, you have to make provision for loss immediately. So in this case, the provision for loss 11 already accounted, loss, 4 rupees further provision has to be made based on percentage completion basis. So this working is a bit, is not as easy as we thought in the mind, but we have to have a look at it. This explains the concept of provisioning for loss immediately. Go through it slowly. Okay, Dineshji says agreed. Concept is same, Dineshji, but the way it is done, you know, we put it the difference as provision. So that's the interesting part in this. This is really a super standard, and we are seeing a lot of errors in many businesses because blindly we just follow. So for all others, I hope it is clear. Simple percentage completion method. How to apportion the loss on the contract, and it should be done immediately. Don't wait for the quarter to come or the building to complete to put that. That's clear. Now this is for you in the PPT, so I'm not going to do it here. It is just giving you a question where, you know, year by year how the cost moves up and down. This is like homework for you. So this case study will give you a very clear example of how to do percentage completion year on year. So this is not for our class. This is actually for our you know, your internal reading. When you download the study, you can just do it. We discussed ICAI real estate guidelines. So 3 things you have to keep in mind. 25% expenditure should cross. 25% of the project should be sold. There must be contract, not just verbally sold. Out of the sold contract, at least 10% of the revenue should be realized, cash, not billing, realized. So if you can satisfy 3 conditions, you can do percentage completion method. Otherwise, CWIP. Okay, so this is very clear. I think all of you know also about the guidance note. And as I told you in the Ind AS, the same thing is put in as a guidance. Again, the 25, they have put it as a guidance. And even for regular flats also, you can do percentage completion under Ind AS. So all these have been clarified. So the real estate industry is now relaxed. They know exactly what to do. In cities like Mumbai, etc., there is development rights. You know, it's very, very big business because the space is so congested. You can sell development right, FSI, floor space, so many things like that. So this is a big business. AS7 gives some guidance on it. Even though many people are not aware of this guidance and it is not done correctly, you can purchase the rights or you can give up the rights. This is a business. So purchased TDRs are accounted at cost and surrendered TDRs are accounted at fair value or net book value of right, whichever is less. So these are 2 concepts, very simple, nothing major. As long as you can understand purchase and this one, there is no confusion. Now, again in construction, you know, allocating performance obligation. This is something you need to clear it up. Transaction with multiple elements. Contract, there will be rental for unoccupied premises. There will be sale of decorative fittings, construction. So you'll have to allocate the sales price to all the 3. You cannot use, you know, 25-25-10 rule for sale of decorative fittings and rental income, etc. So this is when you get total contract, split it up. Again, split it into building, plant and machinery, etc. Depreciate it separately under component depreciation. And show the income also. AS7 income is the first block. The rest of it are like sale of goods or service. So AS7, AS9 sale of goods, AS9 sale of service. That's how the real estate transaction goes. Disclosures are very simple. You already know disclosures. You write about the project and 2 things Billed and unbilled amounts also you should write, because many times construction is reached a certain milestone but not yet ready for building. So unbilled also you should write amount billed not recognized as revenue, and revenue recognized not billed, same, up and down. So these are the two things which you need to put in mind. So this brings us to the end of our simple AS9, revenue recognition. Revenue recognition for sale of goods, sale of service, and interest, dividend, royalty, and real estate construction, which was very simple. Just to recap, sale of goods is risk and reward. Sale of service is proportional or percentage completion or completed contract. And dividend is based on AGM approval. Rest is accrued. Then real estate, you have the two methods of accounting. So it's very, very simple, but conceptually, maximum mistakes are happening in AS9 in the notes, because profit on sale of asset, revaluation, etc., are all put under the definition of revenue in the notes to accounts under revenue recognition. Do not do that. Those are not revenue. These are other income. Okay, so I hope that's all clear. It's just put in chat that up to now we are very clear, because now the next one we are taking up is really one of the good ones where COVID related concepts we can discuss. I would request at least some of you are listening to this, please put up to now we are clear, so that I know that it's not getting boring. Let me take one question from Krishnanji. Anybody put in chat, please, if in the question answer. Krishnanji says, yeah, Chandrasekharji says, thank you. Premnath, Venugopal, you all, thank you. That's good. Dineshji, interesting. If the INCOTERM is FOB, can the seller recognize the income once the goods are loaded on the ship? Correct. Free on board means I put it on board and finish. Absolutely right, Krishnanji. Rajalakshmi says it's understood. Some more people, please put in chat so that I also have some interest to move on, because the next one is very, very interesting, and it explains to us when you are finalizing audits now or going to finalize. Very, very important. And what is the standard? Contingencies and events occurring after balance sheet date. Most important for us to understand, COVID has hit. March 25th lockdown has happened. So 7 days before closing date, COVID has hit. Now, post-COVID, many big companies have collapsed. Service companies, travel companies, online companies, so many companies collapsed. Airlines, so many things. One big casualty, closing stock valuation. Up to the time of COVID, everything was good. But after COVID, people don't have money. So I've started selling the products at a discount in the market. So inventory valuation, classic example of this standard. Inventory valuation is cost or net realizable value, whichever is lower. Okay. So net realizable value is what has happened. I have an AC at 15,000 cost. And I always used to sell it for 20-25,000. Now, because of COVID, my sales in April, May, June, the AC is being sold for 12,000. I'm just disposing of my stock because no takers. So what has happened? Events after the balance sheet date and the accounts is not yet signed, the inventories have come down valuation. That means March inventory also I should go and change. Most significant impact of COVID in India. So that's what we will discuss another 5-10 minutes. What is a contingency? Two things definitions are there here: contingency and events after the balance sheet date. Contingency means something for which we are not very clear on what will happen. It is based on many things. Act of God. Events after balance sheet means very simple. From 31st March up to the day the board of directors meet to approve the accounts for a limited company. Okay. Or in a partnership or in a proprietorship. From 31st March till the signing date of the accounts. But for companies, it is board meeting date, not AGM date. For partnerships, etc., it's the date when the partners or the proprietor approves the accounts. So that because of COVID, most of the accounts are still being signed and people are still not accessed. Money is not there to complete audit. So many issues. So from March to September, so many things has happened. Will it affect the conditions of March is the one question which we have to understand. So let's have a look at it. Contingency means, like in AS7 we read, all contingent losses should be expensed off immediately. Don't wait. So one of the laws could be warranties, sundry debtors, so many things like this. Contingent gains do not recognize. Cardinal rule in AS, do not recognize. But in Ind AS, contingent gain, you disclose. So Ind AS is one notch up. Ind AS, you disclose in most cases. Here, nothing. Now, events after balance sheet, now you are hearing every day so many frauds are happening. So if there is a fraud and things are, the accounts need to be restated. Now under the serious fraud office and MCA and so many things, they will tell you go back and change. So fraud is an adjusting event. If a fraud happens, you have to go back and change. Very, very, very important. So if a fraud is now realized for 2018 accounts, you go back and change 18 accounts. So it's an adjusting event. Very, very important to understand. The events after balance sheet is understood in this manner. 31st March was the balance sheet date and the board of directors approved on 17th May. So this period, any changes is called an adjusting event. After this period or before this period or after this period, it is a non-adjusting event. Not part of this scope. So up to board meeting date, 31st March to board meeting date is events after balance sheet. If it is proprietor partnership, the account signing date. Okay. Two types of events are there: adjusting event, non-adjusting events. Adjusting event means as of March, some things have happened. Hence, you have to change. One is COVID-19, inventory valuation, classic case, sundry debtors. In April, debtor went bad, insolvency. You provide in March. Go back and change. Non-adjusting events. Fire happened on 1st April. Factory destroyed. 31st, there was a factory, and 1st April, factory destroyed. Non-adjusting event, only disclosure. But because factory is destroyed, I don't have any more production, then my going concern is affected. So this standard also tells that if your going concern is affected, then you cannot make the accounts with accrual and outstanding. Just close the account, say going concern is affected. Cardinal accounting policy change, major problem. So I hope you understood. Adjusting, non-adjusting, nothing major. Can you try this question, anybody? Anybody can try this question. What is the answer? Now Rajalakshmi says fire occurred after March and stocks destroyed. Correct. That is after March, Rajalakshmi. So it's a non-adjusting event. But if it is affecting your going concern, then there is a problem. Anybody this answer? Nobody? Anybody can put this answer on question and answer. Not required, Christian Ji says. So it is required because before signing the board meeting, before the board meeting date, my debtors as of 31st March has got impaired. So impairment of receivables before board meeting is an adjusting event. Okay. Now this one. something similar. Try this. Then Chandrasekhar Ji's provision, yes, provision should be made. Dinesh Ji says provision to be asset is a condition existing on balance sheet. Yes, good. More people, please put in suggest not to be made. Balasubramanian Ji says. Let's see. Should not make provision because it happened after March. This is earthquake or whatever it is. Non-adjusting event. Now, proposed dividend we discussed. Please read through. Proposed dividend is no longer an adjusting event. It is a non-adjusting event. So please, all of you need to understand that. Yes, Dinesh says a note will assist in better appreciation. Correct. It's always good. You should write. I have so much. This is a non-adjusting event. Disclosures are important for adjusting and non-adjusting. Adjusting means you pass the accounting entry, but non-adjusting means there 100% disclosures needed. Dividends, you are all aware. No more proposed dividend adjustment is there. Dividend will be accounted only on AGM approval date. So normally in India, most of the AGMs happen in Q2. So Q2 is the period when dividend income will be recognized by all people, expense and income, generally in India. But we discussed before, subsidiary holding company, same owner. So board meeting is sufficient. You don't need to wait for AGM to pass and then recognize dividend. So please keep in mind. Now COVID-19 advisory, most important. Please read through SA 570. Going concern. Because many companies are having this problem because we don't know the receivables, whether it will be received as of March because of COVID, and inventory, we don't know whether it can be sold at that value. Is there an impairment? So what you need to do, the standard of auditing 570 revised says, discuss with management, write it in the notes, write it in the audit report. In the notes specifically write comment about liquidity, inventory and debtors. Whether management expects to realize the debtors, get it in writing from them. Inventory, you check the sales of April, May, June, July till board meeting date to see the price. Are they selling at price less than closing stock price? If it is yes, then go back and change closing stock pricing. Net realizable value lower will be there. So very, very, very important. COVID-19 SA 570. Then ICAI is also sensitized to this nature, especially valuation, insolvency, impairment provisions. You know, we have our accounting standard on impairment of assets. Impairment of assets means whether the future cash flows can cover the cost of the asset on March. Now, because of COVID, what has happened? The value or fair value of the assets have all come down in the market. Now, like stock price, etc. But remember, these have come after 31st March. So you are keeping a big goodwill or a big item in your books where you know that the value has reduced after March because of COVID. But there you have to take care. The decline in market value of the investments are after March. So you should not consider it is not a adjusting event. It's a non-adjusting event. Now, a lot of people are getting tempted to go and change marks figures because maybe in the month of May, the valuations have started dipping. Now, that happened in May. Now, it is not a condition which is in March. So, you have to be doubly careful. COVID-19 impact, people are getting confused as to adjusting, non-adjusting events. Entities must disclose significant recognition and measurement uncertainties. So, you should write in the notes to accounts, beginning itself, accounting policy, You know, there we write it is based on going concern, accrual, estimated. There you should write estimation uncertainty. In the notes, you open a separate box and make sure the management fill up that box saying that accounts are prepared based on certain information, but because of COVID, information is changing. We are not really sure at this stage, but we are taking care. As of today, we don't see any problem. So estimation uncertainty must be in the notes to accounts compulsorily. Without that, don't release any notes. Okay. So this is as far as the AS4 is concerned. It's a very interesting, simple standard, basically dealing with currently our situation of COVID-19, where there is a lot of, we don't know really events after balance sheet, how it is going to go on and how the things are going to change. Okay, any comments, anything in the chat? Are you able to follow this AS4? Because we have one more very small standard and then we can finish. Anybody, any suggestions? Because this is very, very important AS4, especially inventory valuation, decline in prices of stocks, etc. Thank you, Dineshji. Anybody else, any suggestions? Is it understood now, AS4? Especially COVID impact and ICAI guidelines. I would request if more people can put up in chat so that I also know that, you know. Yeah, practical examples on COVID impact. First one I told you, inventory, Balasubramji. Inventory valuation. Primary hit is inventory. Cost or net realizable value, that valuation standard AS2 catches us there. So if you feel inventory has gone down, change the figure as of March. Then going concern issue. Service company and online travel ticket companies, tour operators, taxi fleet, all of them in distress. So many of the accounts you might not be able to sign saying going concern is there. You don't know. So you need to check with management, look at liquidity profile or maturity profile of the liability. All the liabilities are 31st March, you draw a chart, payable in 1 year, payable in more than 1 year. And if you feel for the next 1 year, they can have funds to move on, to pay those liabilities, then you are reasonably sure that, you know, going concern is not affected. So please immediately do maturity profile of liabilities. That is a first test to know going concern. They will tell you no problem is there, especially tourism sector, online travel booking, air travel, all kinds of traveling movement sectors, and all other sectors affected due to COVID. We don't know, especially small industries, SMEs. Got to be very, very careful there. It can be seriously hit. Then valuation of equity valuation. Take 31st March value only. Don't be tempted to take low values of May and say it is impaired. No, that has happened after March. So only disclosure in the notes. Receivables and inventory are the two big ticket items which you need to know. Thirdly, this percentage completion method. Many projects are halfway. So you have to have a detailed project analysis to find out whether this project is really going to complete. Contingent losses are expected because of timing delay. Legal case could come in. So provision for legal cases, interest, expense or income might need to be booked for delays. So all percentage completion, work in progress, software work in progress, all kinds of incomplete contracts. Make sure you sit with management, draw a chart, write estimation uncertainty, disclose in the notes. In the audit report, specifically comment on COVID impact, 100%. Without COVID impact, do not release any audit report, and you write clearly there. There is uncertainty, but as of today, many collections have come in. March debtors are largely getting collected. Inventory is moving. There is no shortfall. So these are some of the suggestions. Then practical examples. Then another one. Venugopal's question, Venugopalji, because of COVID, debtor became insolvent and no possibility of realization. Yes, 100%. All debtors are adjusting events. If it is before board of directors meeting, it's an adjusting event. Please correct. Now, moratorium on interest. Very, very interesting question. If the bank has waived it off for you, there is no provision and there is no income also. So you have to wait for, now recently the banks have taken some decision. There will not be interest on interest. But moratorium means it is only a payment delay. You have to make provision. But if the bank is saying moratorium is cancelled, it's not moratorium, it is a cancel or a waiver, then no need to provide. But as of initially, the first 6 months was moratorium, postponing. Postponement means provision is mandatory. We cannot escape that. Unless the bank tells us that initially the bank said the interest will be converted to principal. It becomes a loan. So for you, it has become loan, balance sheet impact. But now they have said recently interest on interest, will not be calculated and all that. Non-provision is only if the bank writes it off or gives you letter. Otherwise, provision. So I hope that is clear. What disclosure required of if going concern is not there? Two things. If going concern is not there, Prabhakarji, first, qualification. Two, you cannot make provision prepaid or receivable payable. It will be cash balance sheet. As is where is balance sheet. Because there is no going concern. So you don't know. You cannot say receivable is there, payable is there. There's no receivable or payable. We don't know. Payable might be there. You have to look at legal complication, etc. Stocks, what do? It's a debt company. Write off. So you have to see. So going concern basically not there means it is a cash balance sheet. Our old system. No mercantile accrual, no accrual accounting. Now, unless the company can prove that no, we will sell off whatever inventory is there, or we will get some receivables, we don't know. Provide for all uncollected amounts. So that is a concept. I hope that is clear, Prabhakarji. Whether Companies Act will allow? Yes. Insolvency code, everything, it is already allowed. Okay. More questions, please post. Then we will have a quick look at one simple standard that just take 2 minutes only. Government grants accounting. Government grants means many times the government gives you loan at small interest rates. Government gives you free assets, or government will subsidize your company. So these are all called government grants. And in various places, it is called in many names. Some call it subsidies, some call it duty drawback, some call it cash incentives. So government supports the business in many ways. Fundamental rule, if the government is giving money in the form of a capital contribution which they don't want it back, you cannot show government as a shareholder. So show it as capital reserve. Cardinal rule. In India, capital reserve is not allowed. So just remember, only in AS capital reserve can be put for capital contribution of government. In India, it's just not allowed. Now, there are only 4 slides. Government might sometimes give non-monetary assets like land, building, etc. free. They say, take this land, you build your factory. In that case, put it at nominal value, 1 rupee or something. That's the only way. Non-monetary assets. Non-monetary means land, building, etc. Then, government might give grants for assets, depreciated PPE. So you have 2 options to account for assets. Either the grant will be reduced from the cost of the asset. So net assets will be there. On the net assets, depreciation is calculated. For example, if asset is 100 rupees and government has given you 60 rupees as subsidy or something, you can account the asset at 40 rupees. On the 40 rupees, depreciation will be calculated. Option 2, show the assets at 100 rupees and on the liability side, you open government grant, 60 rupees. Depreciate the asset, amortize the grant. So net effect in P&L will be same, which you know. So either net entry or you account on both sides and depreciate and amortize both. Impact on P&L will largely be same. In the second option, depreciation will be there, amortization also will be there. Now, if it is grant given for non-depreciable assets, then what to do? So in that case, many times the grant is given where there is no performance condition. So you just credit it to capital reserve. But many times they will give obligation. You have to do this, you have to file this report, you have to get 10,000 connections, something. So if the grant is related to doing something, allocate the grant as per what you do to the P&L. If you have to do 10 conditions, if each condition is passed, 1/10 of the grant, charge it to P&L. So you have capital reserve and asset accounting. Then you have grant relating to revenue. Revenue grants means to P&L as based on performance obligation. So there are two types of presentation people do. Either they show it as other income, or just like assets, from the expense they will reduce and show net expense. So choice is yours. Promoters' contributions, capital reserve. So simple government grants accounting, you understood, is very, very simple. There is no complication. Easy way, if government is giving you money to buy computer assets and all those movable PPE or any kind of PPE where depreciation is there, that means other than land, then you can reduce it from cost of asset or show it as asset and deferred income and just write it off. Both options are allowed. There's no issue. But if the grant is for land or something like that, show it as nominal value, 1 rupee or something. And if the government is giving capital to your business, capital reserve. Now, this is a classic example where government grants that are receivable as compensation, many times you will get compensation as government grant. So you treat it as an extraordinary item in your P&L account. Because they will take your land sometimes, building, or for highway, they will give you compensation. So all those things show it as extraordinary item, AS5. Okay. So these are the four accounting standards what we have done today. These are basic standards. If you have any doubts or anything, you can contact me, send this email or send to my mobile WhatsApp. We will reply to you, or you can send it to ICAI. We will reply to you. It's very, very interesting. And whenever you are doing accounting standards, the most important thing to know is that the accounting standards should be read keeping in mind the Ind AS also, because the Ind AS has got a completely different formula. So for each accounting standard, now AS4, we did contingency and even AS4 and the Ind AS 10, both are almost same, no change. While revenue recognition, completely different. AS9 and the Ind AS 115, very different. Government grant accounting, the Ind AS has got more complication. So these are the things you have to keep in mind. Any questions on government grant? Thank you, Rajlakshmi. Now, Arti's question. If the grant is received for depreciable assets, then will these assets will also be reviewed for fair value at every balance sheet date? If yes, then we follow option 1. No, there is no fair valuation, Arti. For depreciable assets, no fair valuation at all. Because I have to buy the asset from the market, so there will be a sale bill, that is a fair value. So there is no need to, what you suggested, that fair valuation option is not there. Now, other questions. Premnathji's question. How can one go back and change the stock value due to COVID? Very, very interesting question. Now, what Premnathji is saying is that how you can do it. Now, ICAI, see, if you look at it, Premnathji, what is our AS2, accounting standard on inventory? What does it say? Inventory is lower of cost or net realizable value. Net realizable value is the value in the future. So future means up to the date of board meeting. So COVID, if it has impacted the value, you have to go back and change, because then only you will fulfill AS2 requirements. So I hope that is clear. Both for Ind AS and AS, same concept. Now, Chandrasekhar Vidyut's capital reserve not allowed in Ind AS, correct? Ind AS does not recognize that whole concept. That's it. Ind AS has got a different concept. You show deferred revenue, like what we did now. Deferred revenue concept for depreciable grants accounting, same thing. Capital reserve is just not allowed in Ind AS. Now, then, okay, some of you are okay with what we discussed. If the, okay, Arti's question we just did now. Srinath's question, net realizable value as on which date? Srinathji, from 1st April. Okay, inventory, we'll do a simple example. Imagine I have only one item in stock on 31st March, which is an air conditioner, which is 25,000 rupees stock value. My board meeting was on 1st June. On 20th May, that is 10 days before board meeting, that one stock item of 25,000 rupees, because of COVID, I sold it for 12,000 rupees, discounted. Okay. So this is from financial to date of board meeting. It's an adjusting event. So as per AS2, the net realizable value of that AC is only 12,000 and not 25,000. So AS2 says lower of cost or net realizable value. So I have to go back, change my accounts to 12,000, and the 13,000 will be a hit to P&L, cost of consumption. So that is a very, very big COVID impact. So I hope that is clear, Srinathji. Now, if you have sold over a period of time with many rates, you will have to take average rate, use weighted average concept to find out the average realization rate and take it. Okay. Now, other questions are coming. Just 1 second. Srinathji's question, because day by day value, yes, Srinathji, till the board meeting date, my suggestion, till the board meeting date, my suggestion is that you take weighted average. So you can arrive at an average sale price and compare that average sale price with the cost. If it is less, take this, AS2. Arti's question, I meant, will AS10 be applicable if the grant is received for depreciable asset? Then will these assets will also be reviewed for fair value at every single date? No, AS10 is for our regular PPE. So if for PPE, there is no question of fair value coming there. So Artiji, I'm not very sure about the question. If you could just clarify. If grant is received for depreciable asset, you just reduce the grant from the cost of the depreciable asset. That's all. So there is no fair value concept coming in. That is what my concept is there. Artiji, can you please explain that? I'm not sure of that question.
Unmuted her, sir, so she can unmute.
Artiji, if you can, Artiji, if you can speak, it will be better. I'm not sure whether she is getting this message.
No, she is there in the attended
Yeah,
list. So anyway, we'll see.
Okay. Artiji, I'm sorry, I'm not able to understand that question because in the AS, there is no fair value coming in that. Because I'll read again your question. AS10 will be, I mean, will AS10 be applicable if the grant is received for depreciable asset? Then will these assets also be fair valued? No, there is no fair value concept at all in AS. So you can just leave that, Artiji. Okay.
Sir, can you hear me?
Yeah, I can hear you. Tell me, Artiji.
Sir, I meant that as per this AS10, we need to review our assets like PPE at every balance sheet date to find out if like the net realizable, net realizable.
No, asset is impairment. NRV is only for inventory. For asset, it is called impairment of asset.
Yeah.
Now, impairment is a totally different concept. Nothing to do. Impairment basically means because of COVID, for example, is my assets sufficient to generate the same revenue? Now, because today maybe the value of my asset must have significantly fallen. Now imagine I'm already a factory. I'm a set factory for last 5 years, everything going on well. And I can keep on producing. So because of COVID, the impairment is not going to affect me from factory value, AS10 value, but impairment will affect me from AS9 revenue recognition because my sales might go down. So impairment basically means you have to calculate the discounted present value of cash flow, DCF, for the next 3-4 years. And if your DCF price is more than the asset value, no impairment. If the DCF is less than asset value, there is impairment. So in your case, assume the asset is 100 rupees and government gave you 30 rupees grant. So your asset has become 70 rupees. Now with that 70 rupees, you have to do, you do a discounted cash flow for next 2 to 3 years. And the answer from the DCF has to be more than 70 rupees. Then you are okay. If the answer is less than 70 rupees, the difference is called impairment.
Impairment.
Correct. So you have to, for that you have to discounted cash flow. Now because of COVID, every company has to do an impairment to see, because you don't know your sales now anymore. Especially travel companies and all that, which is hit by COVID. What sales to project, because people can't travel only. So many of them are now caught in the impairment. So as an auditor, you have to be very clear whether if you are auditing a company which is asset heavy, if you're auditing small distribution company where only computer table and all is there, just ignore. Where you are auditing companies where there is a factory and the plant and there is a huge investment in assets, production, or you are, then you have a problem in hand. You have to do impairment testing on 31st March before you release your audit report. For that, you have to ask the management to give you sales projections in writing. Now, what they will give in COVID? Nothing. They will say this year up to December, you can't travel. Like if you take Jet Airways, SpiceJet, anybody, they're really bleeding. They don't know what to do. People can't travel. So you have to look at impairment also from a very matured angle. Just because of COVID doesn't mean everything is dead and death and everything. No, there is a silver lining. Things have slowly started up. Things are slowly moving. So you have to take a very balanced call in COVID. Today, you will see a lot of auditors are now resigning from public company audit because they are scared now. Because they will sign the balance sheet and next year, March, they will realize that debtors are all insolvent. DCF is not there, impairment provision is not there, estimation uncertainty is there. So this is a very crucial role for us chartered accountants, where AS4 is a very big standard. We have to think carefully and take valued judgment. Lots of things with management. Check the transactions from April to today to see whether things are going bad or good. And if you're doing travel companies, etc., going concern, definitely qualification will be there, because they cannot go forward. Many of them are bust already. Internet companies, travel companies, The other method, as I told you, is that as of March, you work out maturity profile of the liability. That means, what are the liabilities payment dates for the next 1-2 years? If for 2021 they have to pay maybe 2 crore of liability, you check whether 2 crore of cash they can raise or they have in hand. If they are having that in hand, then there is no going concern issue, because they have fund to push through. Now, whether directors are willing to put their own money and all that, we don't know. So these are very crazy issues, and for which there is no correct answer. It's a balanced judgment call. That's why ICAI is also saying, look at SA 570, look at all the standards of auditing, and then look at AS4. AS4 is the mother of all the things now because of COVID. Contingencies and sheet date. Very critical. So take very balanced and serious view. So I hope that is clear, Artij.
Yes, sir. That's clear.
Okay, thank you.
Thank you.
Anybody else? Any questions? Anything? I can't see any more questions in the question box.
Yes, sir. There's no questions as of now. Let's just see.
There
is one question by Mr. Srinath Venkatesh. Sir.
Now Srinathji's question has come. After 31st March, if the 25-25-10 reduces to 25-20-10, will rule change? No, because once it starts, 25 rule has started, then it doesn't change because you already crossed the 25 limit. Construction has progressed 25. The 25-25-10 is to start percentage completion. After that, you know, because of COVID, for example, now everything stopped. At 30%, everything has stopped now. Once you cross the threshold, you continue percentage completion. No other choice. So I hope that is clear, Srinathji. Anybody else? Any
no, so as of now, no. If anybody wants, we can unmute them so that they can ask directly.
Yeah,
rather than
anybody,
typing
you
out.
can talk, chat, anything. We have plenty of time. If you're bored, we can stop also. No issues. But please mark AS4 and keep it in mind this COVID impact this year. So notes to account should contain estimation uncertainty notes. Audit report also should contain COVID-19 notes under emphasis of matter. And refer that emphasis of matter to the notes. This estimation uncertainty. I think there's nobody, I think.
Yes, sir, there is something around 100 participants as of now, but there's no questions. Or they have raised the hand. I have unmuted them, but they are yet to unmute themselves and speak.
Okay. Then we'll wait for some time.
Yes. And also the handouts column I have posted your PDF, so I have updated your PDF and
so they can update it, correct.
They can download it from the session. So tomorrow's session also will be updated once the speaker gives the material, so they can have one bunch of the link.
No problem. No problem.
So there is one question.
Yeah, thank you. That's a good, thank you question. That's good. I'm very happy. Thank you for sending thank yous. That's a good thing.
Yes, absolutely. Interactive session. Okay, sir.
Thank you.
If that is the case.
Thank you very much. If you have any doubts, you can send WhatsApp or anything. My number is there, so you can send WhatsApp and all those things. Okay, now we have one question has come, Srinathji. Some companies extend the year-end billing beyond 31st March. No, you cannot extend the year-end billing before 31st March. That's the whole issue, Srinathji. It's just not allowed. Cutoff is 31st March. After that, it is not income. It is the next year's income. Thank you, Dineshji. That is all great praise. I'm not good at it.
So we'll share you the feedback from the participants.
Yeah, so this number and mobile and all is there. You can call, contact from ICAI. Will respond to you. Anything 24/7. You can write, email, WhatsApp. Thank you very much for bearing with this. So shall we close or?
Yes, sir. We'll close the session. So there is no question as of now. If there is any, they can post it to your email or mobile number. And if there is any to us, yes. If there is anything posted to SIRC, we'll post it to you, sir. Okay. So thank you. Thanks for your time, sir, and for a wonderful session. And we'll close this now, sir.
Thank you very much. Thank you, sir.
Sure.
Thank you.
Thank you, sir. Thank you. Have a good day.
Thank you.